Hello, in this lecture we'll be discussing the average cost inventory method. At the end of this lecture we will be able to explain the inventory process under the average cost method, calculate inventory cost flows using the average cost method, record journal entries related to inventory cost flows using the average cost method, and explain the effects of journal entries to accounts on the trial balance using the average cost method. So remember that when we talk about cost flow methods, we're thinking about the first in, first out method, the last in, first out method, and in this case, the average cost method. The average cost method is usually the one that will be in between in terms of the effects on the financial statements between the first in, first out method and the last in, first out method. It is probably one of the second most used methods. And the average cost method will, of course, give us basically an average when determining the cost of the inventory that we sell. So if we start off, we can think about starting off in the same place, whereas in this case, we have inventory of $5,000 on the trial balance. If we want to get some backup of that $5,000 in terms of where does that $5,000 come from, just like any other account on the trial balance, we could look at the general ledger. That's one form of backup to any account, which will generally give us backup by date. It'll show us the transactions to that account by date. But in the case of inventory, we want to see information oftentimes in terms of how many units are in there and how much do those units cost. In order to do that, we generally have to have a separate worksheet, which could look something like this. In this case, we're starting off in the same area in that we have 100 units. They cost $50. And that is backing up, that's where this 5,000 units come from. Remember that when we talk about these assumption methods, these flow methods, we are not talking about the actual flow of the inventory, may not be the actual cost of the inventory we're selling. It's going to be an assumption. One of the criteria for that is that we're usually talking about units that are going to be the same or homogeneous in nature. So the units that we are talking about are generally the same. In this example, we're going to assume that prices go up over time, which is considered to be the normal process in the normal business cycle. Prices of things go up over time, all else equal, because of generally just inflation. Now, it could be that prices go down, but just to have in normal situations, usually the price of things such as inventory will go up over time. Okay, so we're going to purchase 400 units costing $55. So this is where we're starting off again. Remember that we've got the 100 units at $50. That's the 5,000 units. We've got the 100 units at $50. That's the $5,000. We have the $5,000 worth of inventory down here on the trial balance. We can see that the assets are up top in green, and they are debits represented by the fact that they do not have brackets. Then we have the liabilities in brackets because the brackets represent credits, and then we've got the capital account, and then we've got no income yet, and we have these expenses. We then have net income. In this case, it's actually a loss because we have no income, and we have expenses of $500, $300, and $9,920, which comes up to this $10,720, which is a loss as of this time. So if we record this transaction, then in terms of our worksheet, we see that we have, as of this date, I'm going to put a box around our new information will be down here, our new calculations, and we bought 400 units at $55. We can see that, of course, the price is going up from $50 to $55. They're the same units, it's just the price is going up. If we're going to do the calculations, there's a couple different ways we can look at it, but let's think about it this way. We're going to say that we're bringing this layer down. We got the same 100 units that cost us $50. That gives us the $5,000. Then we have another 400 units that I'm just bringing this down underneath. 400 units at $55 to give us the $22,000. And if we add those up then, in terms of units, we've got the 100 units plus the 400 units. That gives us the 500 units. Then if we add up the total dollar amount first, we've got the $5,000 plus the $22,000. That gives us $27,000. And I'm actually going to back into this number then last. The 54 here is going to be the average. How do we calculate an average? Well, if we paid $27,000 for all of the inventory divided by the number of units, which in this case would be 500, then we're going to say the average is about $54. So that's how we're going to calculate that. Note that would make sense because it's between the 50 and the 55. Why is it greater towards the 55? Because we have more units that we paid 55 for than the units that we paid 100 for. So we can't just add the 50 plus the 55 and divide it by 2, which would be a form of average. We're basically going to add up all the units and the cost, divide that out. If we wanted to then prove that to be correct, then we could then calculate again, now that we have 500 units times, we're going to say they're $54, 54, that means we have an ending of 27,000 here. So if we look at the journal entry, once again, the journal entry is pretty straightforward because we paid 22,000 for it. We don't need to do this estimate in order to record the purchase journal entry. It is what it is. That's how much we paid. So that means that inventory needs to go up. Inventory has a debit balance. How do we make something go up? We do the same thing to it as what it is, which in this case is another debit. So we're going to put the debit on top, increasing inventory. We're going to assume we paid for it on account in this problem. Therefore, we're going to credit accounts payable. Accounts payable has a credit balance. We need to make it go up because we owe more money on this transaction. Therefore, we're going to do the same thing to it, which in this case would be another credit of 22. So inventory goes from $5,000 up by 22,000 debit to 27,000, which matches our worksheet up here. And the accounts payable goes from 12,150 credit up in the credit direction, 22,000 to this credit balance of 34,150. Note that there's no effect on the income statement because none of the income statement accounts, being income or expenses, are affected. When will they be affected? When we sell the inventory and then expense it in the form of cost of goods sold. So now we're going to assume that we sell 420 units at a sales price of $85. So this is where we are again. Remember, this is where we are before this transaction. We have $27,000 worth of inventory. That inventory had cost us $50 and $55, but we're just assuming at this point in time that all of them, according to our average now, just cost $54. So in this case, we kind of just have one layer that costs, about $54. Remember that none of the units actually cost $54. They cost $50 and $55, but we're going to take the average, and when we sell the units, we're going to just say that they sold them for that average amount. So what would the worksheet look like if we were going to calculate that average? Well, we're just going to have, as of this date, we basically only need one line here. We're just going to say that the whole 420 units that we are selling in this transaction, what will the sales price be? It's going to be either 50, 55, or 54. And you might be asking, why isn't it 85? Where does the 85 come from? And remember that 85 is what we sell it for. That's our sales price. And we're going to use that when we record the journal entry for the sales amount, but it has nothing to do with this worksheet because this worksheet records what we bought it for, the cost of the sale, not what we sell it for. So what are we going to sell it for? In this case, the average. The average that we calculate, we're going to assume all 500 units that we have cost about $54. So the entire 420 that we sold in this case, we're going to say that we sold all of them for, about $54. And officially you have to say something like, they cost like that, about $54 when you talk about averages. And then that gives us the 420 times the 54 for the 22,680. Then how much do we have left in ending inventory? Well, if we had 500 units at, about 54 and we sold 420 of them, then we have 80 units left. How much do those units cost? About 54. And so the 80 units times 54 is 4,320. That should be what we have in ending inventory. What does the journal entry look like when we record this? Remember that we have to record this first journal entry before we record the cost. This is often lost when we start to focus in on the cost because this first journal entry really has nothing to do with the cost of the sales. It has to do with the sales price. And this journal entry is the same journal entry we would have under all the methods and under a different type of company, being a service company as well, meaning we're going to sell it. If we sell it on account, then we assume that people are going to owe us more money, and so accounts receivable, which has a debit balance, needs to go up because people owe us more money. How do we make something go up? We do the same thing to it, which in this case would be a debit. So we'll debit accounts receivable, and then we're going to credit something for the same amount. We're going to credit revenue, income, or sales, all the same type of thing. Depends on whatever we want to call it. If we sell inventory, we usually call it sales, but it's still an income statement account. Income accounts have credit balances. We need to make it go up. Income statement accounts always go up. How do we make it go up? We do the same thing to it, which in this case would be a credit, and here's the credit there. Then we're going to record the fact that the inventory must go down because we sold it, and we will record the related cost of that sales. So inventory has $27,000 in it. We sold some of it, therefore the inventory must go down. How much will it go down by? It's going to go down by the 420 times, about 54 for the 22,680. How do we make something go down? We do the opposite thing to it, which in this case would be a credit. So we're going to credit inventory, making the 27,000 go down by 22,680 to 4,320, which matches our worksheet up here. Then we're going to record the cost of goods sold, which is basically an expense account related to the using of the asset in order to help us generate revenue in the same time period. Cost of goods sold is an expense. Expenses all have debit balances. We need to make the expense go up. How do we make something go up? We do the same thing to it, and therefore we're going to debit it. So that makes the expense go up by 22,680, and it makes net income go down. So what's the effect on this transaction to net income? Income is going up. Remember, credits represent income by 35,700. Then expenses are going up as well, which brings net income down. So the effect on net income is the increase in income less the increase in the expense being cost of goods sold, meaning that at the end of the day, net income went up by a net amount of $1,320. So we are now able to explain the inventory process under the average cost method, calculate inventory cost flows using the average cost method, record journal entries related to inventory cost flow using the average cost method, explain the effects of journal entries to accounts on the trial balance using the average cost method.